Good morning. I'm delighted to be joined on stage this morning by our three panellists for a discussion on the outlook for equities and what companies and management teams need to be thinking about in 2024. I'll briefly introduce our three investors. Matthew Beasley, the CEO of Jupiter Asset Management, Gervais Williams, the head of equities at Premier Michael Investors, and Aaron Barmfather, the head of European equities at Lazard Asset Management. Thank you very much for being here. So in a similar vein to how Andy started, I'm sort of going to ask you to answer the exam questions. So obviously in light of what we've heard about the macro outlook, what single quality do you want to see companies exhibiting in 2024 in order for them to be attractive, and why? Matt, let's start with you.
I think it's probably quite simple if you want one word. I think it's growth. Given everything we just heard in that macro panel, I think it's fair to say that growth is certainly going to be uncertain in some cases, maybe at a premium. If there's a more nuanced answer, I think it's growth, yes, so top line growth, but it's also profitable growth. I think inflation is clearly still a subject that we're going to be talking about into 2024, and cost bases have been elevated. There is going to stay pressures on corporate P&Ls, and the extent to which growth can be higher than cost growth, your revenue growth higher than cost growth, I think is going to be crucial. So I'd expect growth to be a key determinant of how well certain equities do.
Okay, great. Gervais?
Yeah, I think we're going to see quite a sort of change of pattern. I think we've been in this sort of travel to arrive type thing. Markets are very good at travelling to arrive. And when you get there, you suddenly find things don't turn out quite so well. Markets are vulnerable. So I'm particularly worried about actually profit margins. Up to now, we've been able to get away with increasing prices. Of course, there have been increased costs coming through. But I think we're going to see margin pressure coming forward. Yeah. And I think we'll see a lot of companies getting into financial difficulty, those with high interest burdens particularly, some of the zombie companies, that kind of thing. So I think even sustaining profitability will be quite a difficult
sort of margin resilience is going to be a really important characteristic. Exactly. Great. And Aaron, how about you?
So we want companies that are ultimately in control of their own destiny. I think the environment's a very difficult environment. So growth is phenomenally helpful in that. One of the things we spend a lot of time on is management structures. So we think you can learn a lot from Scandinavian engineering companies in particular, and we can see that starting to spread across the rest of the Europe and even and the rest of the world. And that's about decentralization. It's about decision-making dropping down to the front line. It's about those management teams being able to make better capital decisions and also being more flexible and more adaptable to the environment that they're actually in. Interesting.
That's a really interesting point you raised, because it reminds me very much of a book I'm currently reading. It's actually written by a member of our audience, Jennifer Sundberg, wherever you are. The book is called Collective Intelligence, How to Build a Business That's Smarter Than You. And it's exactly that, the central premise of the book. It argues that the key role of a CEO is really to devolve power sufficiently across a business, perhaps taking decisions more quickly and more autonomously across the business and empowering your workforce. I mean, Gervais, is that something you're seeing in businesses and you like to see? It's a characteristic you look for?
Certainly. I mean, what's interesting about businesses, when you see them presenting, they talk about the financial characteristics, the commercial opportunities, the market opportunities. What they very rarely cover in any significant detail, and I think this is a real glaring error, particularly when you've got margin pressure, is customer service. Very few companies talk about customer service. Customer service is really important. And of course, that is decentralized. Indeed, there's often a sort of them and us between the board and the rest of the employees. And things which actually, the board want to do things which are going to improve the business, but ultimately, they sometimes make what they consider to be marvelous decisions. And they're not actually aware. It makes it harder for the people at the front line to actually deliver customer service. So I think this decentralizing is really important. And it's not just about customers. Of course, customers are really important. Of course, you've got to have motivated employees. Yeah. And so you've got to be really in touch with the employees. And when they're in trouble or if they're having difficulties, you need to know. And all those kind of staff surveys and that kind of thing. Again, how often do you see that in a presentation from corporates? Almost never.
Yeah, interesting. Matt, actually, I'm going to ask you to put your CEO hat on for a minute here, because I think this is something you've been doing at Jupiter, is it not?
Yeah, look, I mean, obviously, asset management is a bit of a strange industry versus other industries where, we sort of manufacturing things, we don't have factories, we have, obviously, people, people are our asset, and therefore managing your people very carefully and diligently is obviously a key part of running an asset management business. I think the points that the panel make are absolutely right, and to some extent, we want to be driven bottom up, as an organisation. Certainly, Jupiter as an asset management company, we are about our individual investment managers and their teams, and we want to give them space, of course, within appropriate risk controlled environments to do what it is that they do best. But I think this actually also goes to a wider point beyond just asset management and into other industries. Is this sense of obviously ultimate empowerment of people. Everyone, well not everyone, maybe most people have a choice where they work. Most people are lucky enough to have a choice where they work, and you want people to choose to work in your particular company, and therefore how you attract and retain the best talent is something that CEOs should be talking about very loudly and very proudly, I would argue.
Yeah, very interesting. So I wanted to quiz you all on the research that Andy referenced in the previous panel. This is a survey of 300 investors, 150 in the US and 150 in the UK. And what we found through that is that the majority of investors think that management teams are less innovative and less likely to take risks today than they were perhaps 10 years ago. Now, you could argue in perhaps a different monetary era then, and borrowing costs are obviously going up now. But do you think that's a fair assessment? Is that, do you think CEOs are less buccaneering today?
I think it's deeply unfair, if I'm honest. I think that we, as investors, have straitjacketed companies over a period of time by asking them to be to under-promise and over-deliver on a quarterly basis, when really we should be asking them to make great capital investments, and sometimes they take a lot longer than a quarter or 2 quarters to come through. Management teams have faced into the Ukraine. They've faced into a monetary environment that's tightened faster than any time since the war. They've faced a whole set of other macro elements to deal with, and yet they've been asked to be phenomenally consistent all at the same time. So what I tend to think about is companies on a bottom-up basis. I'm a bottom-up stock picker, and when I look at European equities overall, return on equity has actually gone up since the pandemic. It's actually the only area in the world that has gone up since the pandemic. The balance sheet is de-geared by over 20%, and it's facing into faster growth. So the geographic exposure has changed. So Europe is now more global than it is Europe, and it has more exposure to healthcare, to technology, much less exposure to things like financials. So it's effectively safer with a higher return, and is obviously cheap.
Okay. Matt, do you think that's a fair assessment?
Yes, I do. I think it's extremely fair, and I think you could come up with a laundry list of reasons why. Elevated interest rates, geopolitical risk, increased regulatory risk, the ESG agenda. Yeah. I think that there is and the City Minister made the points this morning. I think there in society there's a societal asymmetry. We are paranoid as a society around downside risk. I'd argue in financial services, the regulatory environment has created. Financial services regulation is of course designed to protect client outcomes, and all in favour of that, of course, as a CEO of an asset management company. But also, innately there is a disincentivization around risk, which reduces innovation, which obviously has an impact on shareholder returns, but also client outcomes as well. And the risk of misstepping in our society, the risk of misstepping as a CEO, is so large that typically it does constrain putting equity capital, indeed capital, or indeed just risk out there from a corporate perspective.
Yeah, so it's a variety of factors really that's sort of pressing down on them. And Gervais, what do you think?
Yeah, I think Matt's absolutely right. I mean, I think really what's wonderful about markets is they're a discipline. So if you do take too many risks, if you overlook issues, if you get reputational damage, you suffer badly. And in a way, although people have suffered, really it's been a kind of a sort of long-term summer in terms of markets. Yeah. There's been very little. So actually, I think we've got a lot of boards out there who aren't really commercially driven in the way I'd like to see them. And I think that's particularly true of many of the larger companies, actually. I don't think they're bad people or whatever. I just think the culture is, reasonably safe, not go too far off the edge. I think that's absolutely right in that regard. I think you get more innovation further down the market, small caps and all the rest of it, because in a way, the personal reputation is less important. They can do things below the radar to some degree. But I do think it's a big problem, actually. I think in corporate world that actually a lot of boards just aren't commercially driven. They're full of non-execs who are relatively safe, and I don't think that's good enough.
I think also, when we think about de-equitisation, or we talk about attracting risk capital or companies to list, if capital is available to you and you can access that capital without having to list, therefore without some of the scrutiny that goes with being a listed company, well, I can see why that's a very attractive option for certain companies. Now, obviously, I'm the chief executive of a listed company. I could talk at length about the benefits of being listed, but I could also talk about some of the disadvantages of being listed too. But there's no doubt that with capital available now through other sources other than just listing your shares on a stock exchange, it stands to reason, given the risks that we're talking about today, that many companies have chosen to access that capital via different means.
Yeah, interesting. I mean, one thing I was going to ask you about further down the line, but perhaps this is a point at which we talk about it, is obviously IPO market. Our City Minister spoke at length about sort of boosting that. But, we've seen this week Walgreens talking about listing Boots. Now, I'm not going to ask you about Boots per se, but I think what's interesting there is that perhaps a debt-laden business is choosing perhaps to come to market as a way of selling shares. Seems like the best option for them. So do you think we'll see more sort of debt-laden companies choosing not to stay private, but actually coming back to the market? And so will that help London? Gervais?
Sure. I mean, I think we've gone through we're going through a sea change in terms of, I think it's been very easy to have highly leveraged businesses, to get access to capital, to get lots of debt, low-cost debt, falling valuations. It's been wonderful for privately owned companies up to now. But of course, going forward, we're just in a more uncertain world. We've not just the geopolitical uncertainties, we've got more inflationary issues, reshoring is fundamentally inflationary. Worries about immigration mean you get more wage inflation. All of these things are inflationary. And if we're in an inflationary world, then risk capital is what you want. The equity markets are brilliant at risk capital. They're not very good at high gearing, but they're very, very good at risk capital. My view is actually going forward, it'll be much more advantageous to be funded by risk capital. My assumption is there'll be twice as many listed companies in the UK within 10 years.
Great, it's good to hear. Now, I wanted to understand a little bit about your process when it comes to actually looking at opportunities. You or your fund management teams, when you're looking and considering an investment, I wanted to understand a bit about kind of what your process looks like. So the research we've been mentioning throughout, found that investors tend to rely on the raw data they can interpret themselves, be it algorithms they're building in-house, information they find on company websites that they're interpreting, versus intermediated sources, by which perhaps we mean ratings agency data or sell-side equity analysis. So I'm just interested to understand kind of what your process looks like today, perhaps versus 5 to 10 years ago, and whether the use of sell-side is sort of, as much as used today as it was perhaps back then. Matt, let's start with you.
So obviously I don't invest anymore. I used to be a global equity portfolio manager. Obviously don't do that today. And at Jupiter, we're an organisation where we have a range of different investment processes with no one consistent house view. Yeah, I would say that as a business, like I think most asset management firms, we rely on the sell side less than we used to do. There's no doubt there is less depth in the sell side, post some of the MiFID II based reforms that we've touched on already this morning. I do think the ability to use raw data and to analyse raw data is much more relevant and important than ever it used to be. I mean, at Jupiter, we've got a dedicated team of 10 strong data scientists who work solely for the investment teams, trying to use unconventional, non-traditional data to try and enhance or indeed sometimes just provoke and create investment ideas. And we find that adds a lot of value, whether it's in a idea generation or an affirmatory process. And I do think as well that AI is going to start to play a big difference. You're talking around our investment floor, the ability to get summaries of documents, or summaries of annual reports, to look for, if you're a forensic accountant, or looking for particular things that flag to you as important or of areas of concern, the ability to use AI to identify these within large documents that perhaps you wouldn't have otherwise been able to do is undoubtedly changing how many investors approach investment decisions.
So you're kind of creating your own IP in-house, really, when you're your process there, very much your own process that you're building in-house now through data scientists.
Yeah, it's not to say that we don't use external inputs, because we absolutely do. But the ability to use raw data and to process it yourself quicker and more efficiently is absolutely on the rise.
Interesting. Gervais?
Yeah, it's interesting. I mean, there is just a growing war, obviously, in terms of cleverness and computers and data, and there's so much data, and it's you're interpreting all these kind of correlations. Ultimately, I don't think we can win that war as a house. We can have little edges here and there. Sometimes we're ahead of the crowd, sometimes we're not. Actually, bizarrely, the area which has been less behind is actually face-to-face meetings. Right. We maximise face-to-face meetings. As a team, probably we do more face-to-face meetings than any other fund management group in the city. So, and it's lovely talking to people, actually. Yeah. And what data do you inform? Annual report. What I love about annual reports is you can't change it afterwards. You know, you look at the website, you can change it any time you like. The annual report is out there, and you can see what they said last year and see what they said the year before and how things turned out. So again, fundamentals are, and particularly looking at just things like cash, not so much, you know, gearing in terms of with all the leases on the balance sheet from the buildings, but most particularly just how much debt have you got and how much could you raise if you got into trouble in a hurry. All these things, they're very simple things, but then talking then about customer service, you know, staff, you know, particularly engaging with long-term potential for investing capital, as you say, Aaron, get that capital invested. We want companies to invest capital, take a risk. We can take a risk. The great advantage about being a portfolio manager is we've got lots of holdings. So, you know, if the individual companies don't make it, it's unhappy for them. But actually, within the context of portfolio, if many of them just knock it out of the park, we'll get over the disappointment.
Yeah. Diversification is key. Aaron?
So I couldn't agree more about the face-to-face meetings. I guess the thing that we like to do most is actually get on the road. So we actually like to go out to see people in their headquarters. And the great thing about video conferencing and everything that's happened since COVID is that management teams are even happier to see us now than they were before. So we get a lot out of that. And then the other thing I'd noticed that we'd love to hire graduates, and that really invigorates our investment process. And they are tending to turn up now as programmers. Yeah, so it isn't that we do have AI and we have teams of people that do that, but actually inside the investment process, inside the day-to-day analysis, we have people that are automating what we're doing and finding new ways of doing that, you know, on a real sort of bottom-up basis.
So your kind of pool of talent's actually changing a little bit, judging by that. Great. So, I mean, we've obviously talked a little bit about the sort of IPO market, but just going a bit further into that, you know, obviously, you know, there's people have been decrying the lack of new blood and new listings. I mean, maybe you would disagree with that, but you know, obviously that's been particularly pronounced in the UK. I mean, there's talk of things, you know, we've had a few sort of US companies talking about listing, and indeed in Europe, and Japan sounds like it's flying. So just interested on, you know, your view on the IPO market and indeed kind of the prospects for the UK. Gervais, should we start with you?
Yes, well, I sort of obviously just said just now I'm expecting an awful lot of IPOs, not just right now. I think what's been interesting about the IPOs, if you look backwards, is how rubbish they've been in the UK market last few years, right? You know, the Hut Group, what was that, 6 billion market cap, right? Now, about 1 billion now. You know, some of the kind of gaming companies we've seen, you know, Tiny Build, I think it came at 500 million. It's about 2.6 million market cap now. So, you know, these are recent IPOs. So we've just had a really, you know, and I think as fund managers, it's partly our fault. It's not just the people selling them to us. We didn't need to buy them. Why did we buy them? So there's some terrible stuff. So I think we've got some scar tissue to get through from the past. But the great advantage about, you know, a much, not just the UK market, but most particularly a UK market which is differentiated from the rest of the world. We've got a lot of capital-intensive industries here. You know, when the cost of capital keeps coming down, it gets more and more competitive in those markets. When the cost of capital starts going up, suddenly the UK market itself becomes more competitive. The opportunity of a company which has already invested, you know, to build another building or to invest in another sort of energy plant or whatever, actually goes up. So we're seeing the UK. The UK is the best performing market, bar none, pretty much since September 2020. Now, to be fair, it's just been overtaken by the US just in the last couple of days. But anyway, the point is, it's there already. I love markets, but they kind of hide in preview what's really going on. Who's talking about the fact the UK market is one of the best performing markets in the world? And I think will continue to be, I think, for the next 10 or 20 years. But coming back to the IPO market, the best performing part of the best performing market in the world, in my view, is going to be small caps.
Yeah.
And the UK is differentiated from the rest of the world in not just having mid caps, but small and micro cap companies. Again, more innovative, more edgy, more bringing new ideas to the market, all that kind of stuff. So I'm perceiving that smallness, we got too much bigness after globalisation. We need more smallness. The UK actually excels in quoted smallness. I think there's going to be just loads of new IPOs coming in the UK market.
Brilliant. Matt?
Well, there's a structural and there's a cyclical thing here. So, you know, capital raising, you know, the need for capital, it goes in cycles.
Yeah.
You know, why do people need capital? They need capital to expand, or sometimes people want to sell out of businesses, and there's a time, obviously, for both those two things. And I would argue, very similar to Gervais, that we're perhaps on a cusp where actually capital raising becomes a lot more prevalent, and some of the malaise we've seen right now will appear to be cyclical. That said, look, there are some structural issues. You know, I referenced earlier, you know, the attractiveness of other sources of capital other than public markets. I think that's an ongoing theme that, you know, we shouldn't belie. Also, there's a bit of a, frankly, hand-wringing that goes on sometimes in the UK about the decline of our of our primary market. I think there's been a bit of a normalisation to some extent. I'd argue that many investors, certainly UK defined benefit pension funds, were, I'd argue, over allocated towards UK equities 20, 25 years ago, maybe even longer. And so to some extent, you look at allocations towards UK equities now, they're much more in line with where you'd expect them to be if you look at percentage of GDP or percentage of a MSCI World type benchmark. So ultimately the UK it's a strong, stable country. We can all moan a little bit about issues of political instability that again come and go. We can talk about our regulatory environment and whether it could be enhanced or better. But broadly, this is a good place to do business. This is a good place to establish businesses. It's a good place to find attractive talent to staff those businesses. And there will be a cycle. And I think we'll look back in, whether it's a year, 2 years, or in Gervais's eyes, 10, 20 years. But I certainly think we'll look back in a couple of years' time, and some of this malaise we see, or some of this downbeat assessment we have about the death of the UK equity market or the IPO market will look somewhat odd.
It's good to hear. Aaron?
I think this is a bit chicken and egg, to be honest. The UK market is just too cheap.
Yeah.
Every single sector is below its long-term average. 8 out of 12 are one standard deviation away from their long-term average. So as a seller, why would you come to the place that you're going to get the lowest price? Why would you do that? So it has to kind of self-correct, I think. At the moment, if you were selling a business, you would probably want to sell it somewhere else.
Well, look, if public markets don't sort this out themselves, then private markets will.
Yeah.
There's some research published this week by BlackRock and Preqin looking at the amount of private asset dry powder that there is. And they're looking at equity dry powder. I think there's $2.5 trillion of private equity dry powder. You think how much money was raised pre-Russia, Ukraine by a number of notable public equity firms, and how little of that has been deployed over the last year and a half. And look, understandably, given the environment that we spent an hour or so talking about this morning. But if you start to get some visibility in a flattening of the rate cycle, not necessarily a fall in the rate cycle, just a flattening of the rate cycle, so an ability to have some confidence about what you might be raising debt at to supplement any kind of equity investment that you're making. And if the UK equity market persists at these levels of valuations, you could very easily see private equity starting to correct this valuation anomaly that persists in the UK equity market. And that will change the calculus really quite quickly.
Yeah, that's very interesting. I mean, obviously we heard from the City Minister about wanting to make our markets match fit. And there's been talk of vehicles perhaps that would incentivise retail investors particularly, but indeed a whole pool of investors and sort of helping those companies grow. Now, obviously, Gervais, something Premier Miton has proposed is the GB ISA. So, just interested in your view as to whether we need something like that, be it that form or another, to kind of to help grow these companies. And if there are any drawbacks, perhaps, of such a vehicle. Gervais, I'm going to come to you last, actually. Okay. Aaron, do you have a view on that?
Well, I think the UK needs something structural to create a buyer, because effectively the UK has been a seller of itself for the last 2 decades. Ever since pension funds went from being effectively risk-sharing for companies to companies being taking the risk, we've had institutional sellers of UK equities. They used to own more than 50% of the entire market. Now they own 3%. So we're actually the least owned by our own institutions of any major market around the world. So anything that creates a structural buyer on a permanent basis, I think would be a good thing.
I love the idea of a British ISA. What I don't like the idea of pension funds being forced to invest into growth capital. I'm an active money manager at heart. Investment managers should be free, I believe, and you'll make better returns by choosing where to invest your capital. But the idea of incentivising people to invest in British companies with a British ISA allowance on top of maybe a standard ISA, I absolutely love as a concept.
Gervais, anything you'd like to say?
What I would say is, it's not going to make a huge difference. There's quite a lot of money going to ISAs. Some of that goes into UK equities already. The opportunity here is to ring-fence part of the ISA, call it a Great British ISA, and see that coming in. And specifically, I think that what that'll do is actually lead to less local sellers. UK OIC sellers have been voluminous in the last 3 years, and specifically, if you just reduce the amount of selling, I think the UK will break out on the upside, just like Japan, and suddenly I think behaviour will change. So in a way, you could say, you don't need it. Lots of private equity guys will come in and do it for us. What a disappointing outcome, right? Let's just put a little bit of money into just a marginal change in rules, And you've got all the things. And then you get a virtual spiral. As I say, I think the UK will be the best performing market, bar none, for the next 10 or 20 years. And you've got to ask, how was it that we had so many insurance companies with 50% in the UK 30 years ago? Yeah. Well, that's because it was previously the best performing market. Between 65 and 85, when we had lots of inflation and capital-intensive businesses had the advantage, the UK was the best performing stock market in the world, right? And that's why people eventually became so overweight. Does that sound vaguely familiar to what's happened in the US, right? I think all that bigness, all that kind of mega caps, I think people are really dangerously positioned, actually, against the change in pattern. And I think the UK is really superbly positioned. So even a slight change with a UK ISA, a Great British ISA, I think would transform.
Yeah.
There's also evidence of this working as well. I mean, you can look at places like Japan. We talked about Japan, which has been a great stock market this year. In Japan, they have the NISA, which is incentivizing you to invest in equities, but also Japanese equities. You look at Italy, where they have something similar as well, that has led domestic capital to invest in domestic businesses. So there's plenty of evidence to say this does work.
Yeah, that's very interesting. Yeah, there are examples of it working, so it should be something.
Why give tax benefits to buy Nvidia rather than actually generate local employment, skilled local employment, generate particularly productivity improvement, and we do need to pay more gas bills going forward, and ultimately to generate local companies, generate obviously local tax take, boost the exchequer's revenues. It's a no-brainer in my view.
And also, I think the point the City Minister made about a cultural shift needed. Perhaps it's a mindset as well, isn't it? Okay, great. So we are getting very short of time, my gosh. So I really wanted to ask you now, so taking a step back, if you look across the equity universe and being as specific as you can, where do you think we'll find the most attractive equities this year? Aaron, let's start with you.
So we can find a lot of value, as we've been hinting at. I guess the most interesting things, it's very widespread. So a lot of environmental companies, be they asset owners or technology owners, have gone from being very expensive to very cheap very quickly. We really like German residential property, and we can buy that at 50% of NAV at the moment, which I think is remarkable. And at the same time, we can clearly see there are a set of growth companies in Europe that if they were if they were listed elsewhere in the world, would be at a very different valuation.
Okay. Gervais?
Yeah, I think actually, as I say, capital-intensive businesses, I think it's the area to go to. But specifically, what we've seen particularly in the last few years with indexation and mega caps and all the rest of it is obviously smallness has become less and less valued relative to bigness. And the valuation difference between big and small is just crazy at the moment. Yeah. So particularly small caps, obviously, as I mentioned earlier, we've got a lot, if you really want to get properly small, get into the UK, right? So the UK small cap sector is just wonderful. I'm more bullish than I've been for 30 years, right?
Wow.
I've been waiting for this moment for 30 years. So obviously, room for disappointment, I may be wrong, but most particularly, that's where I am right now.
Okay, great. Matt?
I find emerging markets really quite fascinating. I think we need to be a bit careful. Emerging markets are not the homogenous asset class that they once were. But some of the structural growth drivers that we all got very used to talking about regularly 10, 15 years ago still persist. Yet the discount for emerging market equities versus developed market equities is really quite large. And look, Gervais used the word rubbish there. It's been a rubbish asset class now for multiple years. However, because of that non-homogeneous nature of the asset class, this is an asset class where you need to be quite careful where you're investing. We're certainly seeing lots of clients come to us asking for emerging markets ex-China. You're worrying about China as a geography, both structurally and cyclically. But in many emerging geographies, you are seeing the other side of that rate cycle coming to pass already. You've started to see rate cuts in various parts of Latin America. And I do think emerging markets are going to find themselves, obviously the dollar will be important, likely on a different cycle relative to, or certainly an accelerated cycle relative to developed markets. And so that plus the valuation discount, I think will make emerging market equities very interesting next year.
Specifically as an active manager, because I suppose you've got the ability to really go into the detail.
Well, it's one of those asset classes where actually to invest passively is not particularly smart, especially given the downside risk that you might you take on, not from a corporate governance perspective, but from a geopolitical perspective.
Yeah, no, completely. So a few sort of quick fire questions. What do you think is the one biggest opportunity and the one biggest risk for companies in 2024? Aaron?
Pricing, I think, is the most important thing. So obviously we've sort of broken out of a structure where raising prices was very hard for a very great deal of companies. So now we're in two situations. Some companies will now be able to continue to raise price over a period of time. Others, quite frankly, won't, but will start to take market share. And so I think we'll see a lot more of a shift in a lot of different company strategies in the next few years.
Gervais?
I think what we're going to see is actually increasingly, some of the zombies going down, some of the private, companies which have got too much debt going down. So I think we're going to see a lot of insolvencies. That's going to be not just, people sort of price competition before they go bust, but most particularly bad debts. But most particularly, obviously, being PLCs, you can actually acquire these assets from the receiver. These are often viable businesses, but for the excessive debt burden. So you can buy them from the receiver, in some cases for nominal sums, like £1. Right? So the risk-reward ratio of acquisitions is fantastic. And we've seen already Next, obviously a very fine British company, which has been making serious acquisitions of Jules and Made.com and all the rest of it. Now, that's great. Made.com may have added for 30 million, including working capital, it may have added 300 million to the next outcome. If you start off as a £100 million company, raise 50 million and add 300 million, wow. Wow. I mean, we're just, So the opportunities for quoted companies with strong balance sheets, with institutional support, to actually get capital to work, to drive productivity improvement, retain employment, generate more economic growth, it's just, we're pretty upbeat.
And challenge?
Well, the challenge has got to be that actually you don't keep an eye on your customers, right?
Okay.
And why are our companies not talking about that? Every presentation should be heavily, tell us about your customers, tell us about how you measure your customer service, tell us of why, it went up and down during COVID, but most particularly, what were the, board metrics last month? How much has it changed over the last 12 months? All this stuff is tremendously important.
Matt?
No, I'll put on my first answer to your first question, what Aaron's just said as well. I think top-line growth is very important this year, but how the year ahead, but also how companies manage their costs is equally important. So it's margins, it's corporate profit margins, and I feel relatively excited about risk assets next year, but I do worry about whether corporate profit margins will be struggling in some sectors and some companies where they don't have that ability to both retain pricing power but also aggressively manage their cost bases.
Great. Well, I certainly feel a lot more optimistic having spoken to you three. We have some time for questions now. So if anyone... Mark?
Thank you very much. I agree completely. It's such a pleasure to be in the presence of such optimism, on which basis I'd like to ask Gervais if he's free for Christmas lunch. But somewhat more seriously, is this, given the rotation that you're describing into equities, and in particular the run of IPOs that you're anticipating, is this the right time to be loosening the prospectus requirements?
Certainly, yes. I mean, the problem with prospectus requirements is actually a bit like annual reports. You just have a kind of doorstop of information, right? And the real information is lost within lots of sort of, boilerplate type problems. Really, if it was just down to me, I'd shorten all the annual reports to 75 pages, because if it's not going to get in 75 pages, just put it on the website, it's going to be less important. So if anything, I think we do need actually to drive sort of this away from just putting more in and it's all covered in all these words, which kind of means that the lawyers don't, find themselves in court. But actually, it just stifles real innovation. It stifles the ability of companies to come. There's lots of companies who may think about coming to the market. They look at the process and they say, really, guys, I've got better things to do. We need to actually make it easier to be listed rather than more harder. Don't get me wrong, there'll be scandals, there'll be things go wrong. But, as fund managers, as active fund managers, hopefully we'll pick out the winners from the losers. We'll get some wrong, but we'll get more right, all of that kind of stuff. So absolutely, yes, I think relax the prospectus agenda.
Anyone else? Stephen?
Steve Clapham again. I'll try and ask an easier question. And I must say I really echo Gervais's comments, because the accounts have become far, far too complicated. I wanted to ask you, the panel, about training. And is your training budget going up or down? And particularly with reference to the CFA, do you think that's a fabulous apprenticeship or a waste of time and money?
Who wants to take that?
I have to go first. Matthew Beasley, CFA, speaking here. I think the CFA it's a great qualification. It's a hard qualification as well. It's hard because it's broad and deep. In terms of Jupiter Asset Management, what we do about training. Yes, increasing, investing heavily in our people. I'll go back to a comment I made earlier. As an asset management company, your people are your asset, and investing in your assets to make them more productive and more valuable to you, to make them want to work with you given the choices that they have, is of primary importance. So yes, very important.
Anything to add?
I have. I hate the CFA. So don't get me wrong. I think it's a very hard exam. It's very hard to pass. And I'm impressed. I am impressed that Matthew and other people have passed it, right? But the point is, everyone passes it. We all think like factory chickens. It just puts a sameness everywhere. We need difference. That's what we need. We don't need people who've got fantastic degrees at Oxford and Cambridge. We need people to come through who have different views. Some people who are less academic, perhaps, that kind of thing. So I just hate something like that, which is basically kind of narrowing the pool of thinking. And specifically, actually, the problem with the CFA, I particularly think, is actually there's very little history in it. We need to know what happened last time, how bad it was, the range of outcomes, all that kind of stuff. So I think, actually, there's plenty of opportunity for improvement.
Aaron?
We don't make a massive amount of the fact that everybody has to do the CFA, but we don't make a big thing of it. So we don't rely on it as a grounding for investment. We think it's much more important to train bottom up and train people around both accounts and financial markets. And I guess what I'm most impressed by is the fact that effectively all of our graduates take on the CFA and we hardly even talk about it.
Yeah. But diversity of thinking is the most important thing. Anyone else? Gentleman at the back.
Luke Ahern from Investec. Just a quick question on, there was a number in the press yesterday that there's $2.6 billion worth of dry powder and venture capital out there. What companies do you see in your areas that are most exposed to venture capital buying listed companies next year? Which companies get bought and what sector?
I'm happy to make a start on that. What I think is funny, I do love markets because they all sort of confuse us enormously. But the point about it is actually the ticket size for private equity has just gone up and up and up over the, as they've got bigger and bigger funds and they need to get hundreds of millions. And so the ticket size is quite so large that actually most UK companies are too cheap for them to buy. How awful is that, right? They're not bothering because the ticket size is too small. If only they were worth 2 or 3 times more, they would take them over. So I think, bizarrely, I don't think the UK is that vulnerable. There will be some private equity deals, but not that many. But they'll probably go to other places where things are much more highly valued. And don't get me wrong, it's cash generation and all that kind of stuff. But most particularly, they've got that nightmare that actually debt is going to cost money, and actually getting the right gearing in there. And then, if you're lucky enough to find that actually debt prices come down, fine. But if you find debt prices go against you, who are you going to sell it on to? I mean, this whole kind of pass the parcel thing has got room for disappointment.
I think safer companies are going to be bought, and the reason for that is I suspect there'll be a lot of losses amongst private equity in the very near future. So I suspect they're going to gravitate towards cash flows, and they will gravitate towards things that they can forecast more easily, because I suspect they'll find that some of the forecasts are going to be more wrong than they'd like.
Any more questions? Jed?
Hi, Jed Brumby, Edelman Smithfield. I was interested in your views on the investment trust sector in particular, given that you have 2 very obvious metrics to measure the size of the business, obviously in the share price and in the NAV, and given so many of them are trading at some of them certainly at quite large discounts to NAV, do you think there's a cynicism on the NAV valuations that's behind? As in, do people just not believe that that's what they're worth? And secondly, do you believe that could drive a series of consolidation, or at least people taking private these companies, because you've got some, often they're backed by real assets, and if you're thinking about building scale in a wind farm or a solar farm or whatever, you could pick up 2 or 3 investment trusts in the space, consolidate them, and you're buying them at a discount, and you suddenly got the scale that you're talking about in private equity terms.
Who wants to take that?
I'm happy to go first. I love investment trusts. I think they're a fantastic vehicle. I think we've shot ourselves in the foot a bit in recent times with the look-through cost challenges that recent regulation has brought to bear and confused investors. I do think the discount point is extremely relevant today. I'm not so sure about the scepticism about the valuation. I think that it's more that I think we know there's a lag effect that obviously kicks in, which is clearly why so many investment trust trade at large discounts. But they're great vehicles for less liquid assets. I'm a big fan of what might be coming to pass in terms of the LTAF being a much more prevalent vehicle. I do believe that most people need a lot less liquidity than they currently have in their own personal portfolios, and trying to incentivise the population at large to accept some element of illiquidity in return for that, if you like, illiquidity premium makes a lot of sense, and investment trusts are a great vehicle to do that. But again, I do think if market participants themselves don't correct some of these issues, and some of these issues are because of the discounts, but also some because of that lack of understanding around investment trusts, then I do think there will be some consolidation. I do think there's a great opportunity for people that are private asset hungry to look at investment trusts as a way of getting access to those private assets. And if you think back to where we were, 3-4 years ago, the competition for private assets, or present private assets with cash flows was extremely strong. Structural reasons why that was strong are still there today. There's a cyclical reason why I think we're all questioning it. But I think over time, again, that discount will go away, which probably makes investment trusts a great place to invest as you look into next year's ISA season.
Yeah, I'm very keen on investment trust too. I think actually, again, it's a sort of, you've got to look at it in the context of globalization, where we've had, mega caps and mainstream indices producing wonderful returns, and unitized vehicles have been brilliant, and people are made out like bandits and all the rest of it. It's all marvelous. Obviously, going forward, we just don't know what might come, but it may be margin pressure, it may be valuations are lower going forward because inflation is more persistent. Of course, there may be some economic growth related to inflation. So there is a risk that markets flatline. In real terms, they do flatline, sometimes for 10 or 20 years. And if we do find that actually there's almost no return from markets generally, then actually those seams where you get real return is where investment trusts excel. Because if you get a really nice OIC in the right place, perhaps in small caps or something, and you get it ambushed with cash, it can't invest any longer. The great advantage of investment trusts is they can limit their scale. So when you've got specialist niches outperforming, they can actually remain dedicated to that niche and not become oversized. And so I think my own view is actually investment trusts will move from discounts, which is where they are now in many cases, back up to normal valuations. I think actually they'll grow. Some of them will get taken over, but actually I think you'll see many of these companies actually becoming more favoured as investment vehicles over the open-ended investment companies, whereas Matt says, basically you've got more liquidity than you really need as an investor for a long time. So going forward, I think actually you'll see the sort of balance between open-ended companies and closed-end investment trusts is sort of very extreme. I think it'll balance up. It won't be that investment trusts will exceed OICs, but they'll certainly catch up now.
Anything to add?
I think people should buy my OIC and then enjoy Christmas.
We probably have time for one very short question. Latika.
Hi there, Latika Shah from Edelman. I was really interested, Gervais, in your comments around how companies aren't doing enough in terms of talking about their customer service. We've got a number of heads of investor relations and sort of CEOs of listed companies in this room. Would love to hear which other non-financial metrics you take into consideration, and actually companies should be doing more when they're communicating their results, etc.
To give you an answer, basically, it will be different for different companies. If you're a manufacturing company, I was speaking to a company which manufactures radiators the other day, and I was saying, tell me about on-time, in-full deliveries, please. And he said, well, you have no one else to know about that. And I said, well, that's not a problem. Perhaps you can talk about it. Do you measure it? He said, oh, yes, I measure it. And then he spoke about it, and it was very good. Share price has halved since the IPO. Well, you weren't invested, but that's. But then I said, your board must be thrilled. Your non-execs must be really thrilled. And he said, no, I don't show it to the non-execs. This is just kind of crazy, right? So you really go, what are the right metrics? For a fund management group, it might be, effective engagement. It might be, have we kept you informed of the kind of nature of the risks and the opportunities and all that kind of stuff? For companies in the service level generally, it's about delivering, obviously quick responses and those kind of things. I want to meet what you can measure. It's not easy to measure some of this stuff, particularly for branded companies. You can talk about unprompted brand awareness. Have you improved brand awareness going forward? All that kind of stuff. So it's different for different companies, but one of the questions is, do you know what your service levels are? Because how do you measure it? And quite a few companies don't even have a very good answer to that.
I am going to have to call time there. So we've now got a 15-minute coffee break. So if you'd like to head out and grab a coffee, we're starting back here promptly at 10:30. So that just leaves me to thank our three brilliant panellists for such an interesting conversation. Thank you so much.